So, good afternoon, everyone. It's a pleasure addressing everyone gathered here, especially doctors and people from the medical fraternity. And I know this is a post-lunch session, so I don't have a presentation, so you don't have to look at the glowing screen. And so I'll speak mostly about what has been my experience dealing with acquisitions and similar growth activities for hospitals. I'll share some of those experiences, and I'll also try to share some of the lessons that you can learn from in terms of how you scale up and in terms of when you look at funding. But before that, when the introduction happened, you were probably told that I'm part of QHI Private Limited. So we are into, or we were formed essentially with the idea of looking at hospitals, small practitioner-oriented, individual practitioners, all proprietary kind of hospitals, and looking at acquiring a stake in them, corporatize them, and get them funded through private equity. And fortunately or unfortunately, we started looking at hospitals when COVID hit, and we found hospitals were within the sort of two extremes. Some were doing extremely well and therefore were asking for unreasonable prices. The others were not doing so well, so their advisors said, wait for another couple of years and you might get higher valuation. So because of that, some of the, we haven't been too successful in the last couple of years, but we have done some smaller acquisitions and funding in that area. And my association with looking at hospitals for either acquisition or all of that goes even beyond that. So I was part of a diligence team, or I led the diligence team for a big acquisition that happened in southern Kerala, it was an interesting acquisition because there were a lot of interesting structural and other issues that were there, but I'll discuss some of that as we get into some of the further discussions in this aspect. So the first thing, usually what happens is when a individual practitioner or sole proprietor kind of hospital is looking to sort of scale up, usually either they will be looking at expanding into nearby catchment areas, or they'll be looking at increasing the size of bed in a hospital, or in a third case, some of them might even be thinking about building a chain of centers or hospitals across a particular location. So these are three typical areas when three typical models when a hospital or a medical care facility would be looking at expanding, and that is when funds would be required. Normally the first door that they'll knock is their own bank. The bank will ask for a collateral, and usually collateral may be there, may not be there, and if you're looking at lease premises, that might be an issue for a bank to fund, and all of these go based on how your relationship is with the banker, and also in other cases how well documented your financials are. So usually what we have seen, I'll give you an example of a hospital that we looked at in the east coast of India, and when we looked at the hospital, they had financials talking about 2 crore revenue during the COVID year. And so we started internally discussing about price based on that. But then once we started discussion with the doctor, he says, no, we did 6 crore. 4 was all, black. So that kind of practice actually, you may think that short term it is very beneficial, but when you go for a funding, third party funding, like when you're seeking investor funding, it can come and backfire, because you can claim 6, you can claim 8, there is no way to substantiate that, right? So that is one big problem that we always face. And that also is a problem with bankers. Some of the bankers share stories like this, not just from medical industry, but from other industries as well, where they know that the proprietor is doing great business, but when it comes to the books, this is what they're showing. And so that kind of short-term practices tend to hit during that time. The same is true for if you're looking for any kind of third-party funding, including looking at private equity investors and things like that. So that is one common issue that we see across. And the other issue that eventually you will come to is investors don't usually fund partnerships or sole proprietors. So you might have to think about changing your structure at that point of time. So if you're not a LLP or a private limited company, that may be required. So all of those changes might be required, and all of this happens while you are trying to expand your business or trying to expand your centers, right? So think of these issues in advance. So that is also why I'm just bringing that up here. The other common issue that we see is, and we can look at this also from, when I look at it from also as a consultant angle, the project report or the expansion plans are usually based on a gut feel. There's nothing wrong with that, but when you ask a third party for funding, that gut feel has to be put in paper. And one of the common things that I find missing is the hospitals or doctors don't usually look at what their catchment area of patients is. If there are other competitors, how that is. What I was talking about is looking at the feasibility of those kind of expansions when you consider expanding your hospital or medical practice, right? So what we find is usually there will be multiple hospitals providing similar kind of services, and they will still be talking about expanding, adding beds, or with the same practice area, they will be talking about expanding in that area. And when we come in as third-party consultants or investors looking at this, we'll say that you have competition even from government hospitals in some cases where you may not be able to attract clients. The other is there are other factors that go into this, right? The hospital may not have enough parking to support if you are looking at, say, larger deep-pocketed clients. So all of that needs to be covered when you are looking at these kind of expansion plans. And in fact, we looked at one hospital in Hyderabad which had a similar case, and what we found is that there are similar practitioners in the next street with similar bed capacity. The street behind there is another practitioner with the similar specialization. And the catchment area that they're talking about is a 7 or 8 square kilometer area that they can service. And so because of that, we were advising them to look at another location if that is feasible. And so that's where we left with that particular hospital. So the other common experience that we have is with hospitals where doctors come together and also run the hospital. So it might have worked in the past, it might have worked with a lot of successful hospitals that you see, but what we find is doctors, if they are focused on their practice areas, specialization areas, they don't have time to spend on hospital management or administration, and a lot of things get missed in that whole process. And usually there won't be a structure behind who does what. So eventually one of the doctors who has either more time or more initiative will end up running, and he may or may not be the best person to do all of that. So I've seen a couple of structures that work really well. That is one where doctors essentially said, we'll not participate in any of the administration activities, management. We might even become shareholders, but they'll do it through a different vehicle. So they set up a separate LLP through which they invested in this hospital. And they represented that LLP through one or two essentially managers who represented them on the board of this particular hospital. So those are some of very clever structures that you can come up with. And the advantages, you get management expertise into the organization. Doctors can focus on their own areas that they specialize in. They can worry about clinical outcomes more than whether the hospital, beds are occupied more, whether there is efficiency in running all of that. So leave that to the managers who run this and to the experts, and then you can focus on your clinical areas. And the other where I've seen is when doctors like this come together, what they'll do is when they need or have an expansion, they'll first invest their own money, and then they will seek out their patients and relatives and bring together a lot of small ticket investors to the company, and they might even make it into a public company to do that. So there is a lot of legal formalities that go with it, but other than that, what happens is if you're thinking of bringing another investor off, or if you're thinking about a structural change where this happened with a hospital in South Kerala, where they were bringing an investor from outside who was running a chain of hospitals, and they had this particular hospital was a private or a public company with about 250 different shareholders who had put in money ranging from 10,000 rupees all the way to few lakhs, and very old hospital, so that's why 10,000. The problem was when this investor came in, when they looked at it, the issue was all of them could not agree on a price, and there was no formal agreement in place which said that if the board agreed on a price, you have to sell. Like these days, a lot of startups do this. But at that time, they did not think about all of that. So then negotiating with each of the representative or potential representative of this small group of shareholders was always an issue. Finally, it became a sort of herding exercise where one of the representatives from the hospital, in fact, one of the doctors spent a lot of time doing all this, bring all these investors to the table, agree on a price. The whole process was delayed by about 6 months. They had agreed on a price, and just getting that money to the bank, there was a 6-month delay because of this. So this happens, and so before you consider all of these options, it's always worth talking to an investor who can bring in probably that much money and look at other ways of funding. And the other extreme of this was a case where we looked at in Gujarat, and there were two hospital buildings that were right next to each other. One was lacking, I'm just giving an example, one was lacking a cardiology specialization. The other had everything else other than the cardiology specialization. And tall buildings, so about 25-story building, owned by these two doctors who are running this. And strange thing is, nobody actually thought about talking to each other, even though they were in the next adjacent plots, because all they had to do was merge this practice and become a multi-specialty hospital. But somehow in the whole, either it is a personality issue or we didn't get into the bottom of this whole thing, but we found it was very strange that that discussion had never happened. And we came in, both of them sent us a proposal for investment, and when we looked at it, our board internal discussion was very interesting at that point, and we had we proposed to both these hospitals, and we visited them as well. And essentially if we had closed on one of them, we were ready to take the other. And there were some, again, like I said, pricing issues that we decided not to go forward with. third and most important point in this whole sort of intro into funding for scaling is one of the common and almost always a deal breaker is that the doctors, especially with the MSMEs, they rely heavily on their chartered accountant, or they have done that in the past for everything from tax filing to making financials to getting bank funding. So they think that the CA would be the best person to go to in terms of getting a valuation done and also to negotiate prices. So I'm saying that's a common mistake, because the practice areas have evolved in the finance profession also in such a way that valuation and this kind of transactions has become more specialized even in the MSME side. And doctors, because they are busy with other things, may not realize this. So this is also, I'm just taking an opportunity to make you aware of this, that there is a very emerging fraternity developing in terms of valuation, and I'm also one of the early part of that, as you might have seen. So here the analogy I talk to when I talk to doctors is saying that you wouldn't go to a doctor who is doing, who has done only postmortems throughout their life and ask about how to do brain surgery. And I know, I mean, it's not, it may not be too accurate, but essentially that's what CAs do, right? They look at financials after all the work is done. And I mean, I've come from that background, so I can easily say that. And so they look at it from a certain point of view where they'll advise on what is the best tax optimized strategy and what is the best way to minimize certain regulatory issues. But that may not be the best way to either approach investors or to take care of governance or even valuation part. So that's also something that most, in fact, it's not a unique thing about this medical profession. It's happening with other areas as well. So usually we find that that conversation has happened, and then when we go and discuss, you know, here on the one side there is a person who has been advising for 20-25 years on financial matters, and somebody like us comes in and says that no, there are hospitals which are selling with higher bed count but at a much lower per bed valuation. That is hard to for a doctor to digest when they are selling their own you know, baby, so to speak, that they have essentially grown through these years, right? So that also comes into play in these kind of transactions. So expectations about what you can get in terms of investor funding also needs to be somewhat right. And now coming to how you fund any kind of expansion, we talked about. So the general rule in finance is when you talk about working capital funding, you always approach banks. It has to be repayable, or it is best that it is a repayable debt. And I'm generalizing here. And so if you're looking at things like you know, expansion, and your only thing you are looking at is to get your working capital funded, there is no need to raise funds from an equity investor. Always look for bankers first. And these days, even though there are challenges, banks are much more eager to fund medical related you know, expansions. And even when you're looking at buying machinery or things like that, bank term loans are a good solution. And one of the issue that most, especially individual sole proprietor kind of doctors face is they have to run behind the banks to get these funding. They have to do all the paperwork or get it done. And the banker will ask a lot of questions which may or may not seem relevant to you at that point of time, but banker is essentially going through a checklist that his bank has, and it may not be successful towards the end. So you go to another bank, And this process keeps repeating, right? So it is a little bit of a frustrating process, but there are other means of funding that are available right now for you. There are things like private debt. So there are players who will fund you at probably a little bit higher rates of interest, but with lesser documentation, and they really like funding medical and doctors because of how good they are in terms of usually in terms of performing. So private financing is an option here, and then once you talk about say once you cross a kind of $1 million kind of, which is now 8 crores kind of funding range, then we talk about funding from other larger, more organized players, like debt funding from institutions which have focus, but those are very rare in India. I have seen that, I've done that even abroad, but in India those kind of institution framework is lacking for in fact med tech or medical pharma, those kind of that awareness is just building up thanks to COVID related issues. But even now there are less schemes, less packaged products that are being offered for this industry. But I mean, and I'm just giving this in comparison to say a lot of startups or others. And here I will take a little sort of deviation and talk about some of the other ways in which you can fund some of your expansion plans. So some of your expansion plans, if you're looking at changing the entire model of your how your industry operates, might come under the startup definition. So that may be a good way of looking at funding that particular initiative. So you separate that from your existing practice area or from your hospital day-to-day running, and those kind of innovative practices can be funded as a startup idea, and you might even get customers. You might even be able to sell it to other hospitals or even players abroad who are interested in those kind of innovation. And the other big attraction is angel investors, etc. would be more eager to fund those kind of standalone initiatives as well. And a lot of doctors that I know, there is a dentist who is optimizing certain dental inputs that I know of who are doing this kind of model here in Kerala. And there are student startups which are getting into this area. I work with one which is about optimizing oxygen flow for ventilators. A couple of students who are just out of college, and they are backed in terms of marketing by one of a French major company in this area. And so those kind of opportunities are available. And if you're also talking about these are pure product plays, but there are also plays where if you're talking about making something smart, that can be a different concept altogether, and you can still get funded for that. So in terms of model, there are others who are working on different models for elder care, which is a big need in Kerala that I know of, and they are that's coming under the startup initiative. And the other form of funding, before we even go into equities, there are revenue-based financing opportunities available, which means that if you have done a certain turnover, you can think of getting funded in terms of these as essentially the investor will fund you and you pay a certain amount per unit sold or per unit of product shipped. So that might apply to some of the non-service kind of opportunities. So that is RBI just recently approved that last year, and through our ventures, which I'm part of, we have funded a few startups and initiatives from the e-commerce space, which are through this RBF financing model. And though we haven't seen any medtech player yet, one is in active discussion and they're based in Tamil Nadu, and we're in active discussion for a RBF type of financing for them. And final sort of option for, all kinds of companies is equity, and depending on how mature your processes are, how well you can deal with investors, you can always look at equity funding. And especially now, again, thanks to COVID, there is a lot of investor interest in terms of funding anything related to medical area, including certain practice areas, diagnostics, and equipment manufacturers as well. There are a lot of investor interest. And depending on scale, there are also foreign players who are very keen on investing in India. And India is hot. Forget the news. If you are following any financial news in the last couple of days, forget about all of that. That has nothing to do with India. Rupee may have hit $80, 80 to the dollar and all of that, but that's happening across the world. I was just reading, sitting here, about how the same thing is happening in Japan, where their central bank intervened. Pound is almost on par. So that has nothing to do with India. It's all to do with almighty dollar. So India is still very attractive for overseas investors. Whoever I talk to, they are very excited about what is happening in India in the last few years. In fact, looking forward for the next decade, most of them agree that this is the place where they should park money, either as investor or they are looking for at least a part or piece of the pie here. So with all of that good sort of tailwinds facing us, you should definitely make use of these opportunities, whether it is equity funding, startup-based funding through angels or VCs or other means of funding. And just because of all this is a great time to think about scaling up. And with that, let me conclude, and if there are any questions, happy to answer that as well.
Yeah, my name is Teddy. I'm part of a healthcare tech firm based out of Infopark. So typically we are scouting for a venture capital or private equity funding. How do we go about, how do we get a lead with the VC or a PE? Because they receive a lot of applications, a lot of startups, and a lot of business plans and pitches. How can we get visibility with the...
And I'll talk more generally about how you go about that. So a typical, if I look at, say, either R Ventures or Mumbai Angels, where I am aware of this data for a longer period of time, what usually happens is there is a funnel, right? So you usually pitch initially to somebody, and then they shortlist, goes to the next level, they shortlist, goes to the investor level. So these two gates that I was referring to earlier, they look for 2 or 3 different things. And you have to clearly understand what that is. So number one, usually the first person wouldn't shortlist you if you are not within a certain investor mandate or investor interest area. So that happens. Second, shortlisting, or you go out of that listing, is because your model may not be as sound as you imagine it to be, or either you are not communicating that well, or the person who looks at it from the other end may not think that your model is not that feasible. And you can ask for feedback. A lot of the good thing about startup ecosystem is they'll be very blunt in giving you these kind of feedbacks, right? So the third common mistakes, again, I always talk, when I talk to startups, I always start with this is, don't go with a very sort of high valuation expectation based on whatever you read in the news media. And I'm talking again as a person who structured multiple deals in the past. If you quote a certain valuation, I can give you a deal structure where you will not capture that value towards the end. You will not even know that that is happening, right? So there are always dangers in doing that. So this is always the first advice I give to startups. So go with a very rational expectation of what you can get funded, but have a view, but not a very strong or a stubborn view on that. Rest is all about how attractive your opportunity is at that point of time and how advanced your model is. And the other common mistake I see is a lot of very early stage startups go and pitch to VCs because they would have heard something in the news about them funding another startup. The problem with that is they may have funded that because of certain other reasons which may not be that clear in the news media. That is always there with startup ecosystem. Second is early stage startups are not always something that VCs look at. So usually go through the angel route, through the early stage investor route, and then so there is a certain hierarchy you follow in that. So you have to also look at that, and I'm happy to have a one-to-one discussion, especially because there are, I mean, I also invest as an angel, so.
So you have the funding agency here.
Right.
Great, thank you. Anyone else? Any questions for Ms.? Wonderful presentation. Okay, if none, thank you so much for your wonderful presentation. I also learned a couple of things that who should you approach under what circumstances. You just think, yeah, you're right that I read it, yo, they funded 500 million to this. I say, oh, why not I get into it, you know? But that reason may be different than what I'm looking for. So it's better to explore what is feasible for you, and you can really get a success without getting much frustration moving ahead. So thank you so much for wonderful presentation. We would like to present our token of appreciation. May I request Mr. Afjal, who is the editor-in-chief of MedGate today, the media partner for this conference, to please hand over the memento to Mr. SESHADRI.